Most of you will know Plato well. It really was a legacy Australian shop with a big income focus. We've now got over 18 billion under management, but what you may not know is that over the last 6 or 7 years, we've made a really big push into global. I joined the group to do exactly that. We now have over 3 billion in global assets. So the Plato Global Alpha strategy, what's distinctive about it? It's a 150-50 strategy. That's basically the most complicated thing about it. What that means is for every $100 that you give us, we've got $150 to invest in the most attractive opportunities anywhere in the world. So that can amplify the alpha that we can generate for you. But we've also got this 50% short leg, okay? That allows us to act as a second alpha engine to generate some tremendous returns for you. We've outperformed the MSCI World benchmark by over 11% after fees since inception and on an annualized basis, and 70% of that alpha has come from the short side. For long-only investors, they can do a tremendous job, identify companies and see companies, that there might be fraud here, there might be some big weakness here, but their hands are effectively tied. Unless you have the handcuffs taken off and you can go short, you can't monetize those views, monetize that alpha. So annualized returns of 24% since inception. Last year we did over 50% return. Year before we did over 30% return. Where does this fit in your portfolios? It's very tempting to think, oh, it's long short, it's an alternative. Well, actually, because it's 150 long, 50 short, the net exposure at all times is 100%. So that's the same as any long-only fund. So this has a 0.98 correlation with the broad equity market. Okay, so as a result, where does it fit in your portfolio? Where these funds are extremely popular in Europe, in the US, is in that core section of your portfolio. It can be used as a satellite as well, but the volatility of this portfolio is also very modest. Some people think long short, they think high octane, sex and violence. This is certainly not that. The volatility of this strategy is very similar to a Vanguard index tracker with thousands of positions. So my prior life, as MC said, I was 15 years in London for my sins, and I was running a variety of long-short strategies, one of which was the Europe Equity Plus strategy. So this strategy I designed, launched and managed for a decade. We generated 4% net alpha per annum in that fund per year. And it went from 30 million seed to 5 billion euro where we hard closed the strategy. Now, one of the most successful funds in Europe over that period, but I am increasingly convinced, the longer I've been investing, that what our end clients ultimately want is consistency. They want to be able to sleep at night. They are increasingly nervous about strategies that might do a plus 30% year, 1 year, and give it all back the next year, because often what happens, as we know, they'll redeem at the worst possible time, capitulate, and their lived experience won't actually match even the fund experience. So we're very much about an all-weather performance strategy as much as possible. Of course, there's no such thing as all-weather. That's just what we're trying to engineer. So what does that look like? For the Europe Equity Plus strategy, that green line shows the cumulative outperformance of that fund over that decade. And what you can see there, it's a pretty smooth trajectory, right? It's not like we're just getting a few calls right, betting on a few thematics and that's working. It's very, very consistent. A pretty corny analogy that I like to use is the great Don Bradman. How many sixes he hit in his Test match career? Don't know if there's any cricketers in the room, but best batsman of all time, average of 99, hit only 6 sixes in his entire career. His whole philosophy was, don't hit the ball in the air, just work the singles. Don't try and be the hero. And that's very much the approach that we believe in, not being overconfident in any one stock or style, just make lots of bits of alpha every day, every week, and every month. Those faded lines in the background were our 40 largest peers within Europe, and what you can see is they have some magnificent periods, but they often, it's a bit of a roller coaster and they can give it all back. So how do we produce that smooth consistency? One of the things I'm a big believer in is style timing is fool's gold. Look, a couple of years ago when interest rates went through the roof, the consensus, unchallenged narrative, growth is going to get smashed. Tech will get smashed. Didn't end up that way. The Magnificent Seven have been absolutely phenomenal. So style timing is incredibly difficult. As a result, we keep it simple, always have the best value, the best growth, the best quality ideas we can find anywhere in the world. So JP Morgan, arguably the best run bank in the world, highest quality bank in the world, trades at a P of 13 times. You know, the net interest margin, 30% higher than our own CBA. CBA trades at what, 26 times, something like that. So great value opportunities out there. Palantir Technologies, we bought 3 years ago. It's up 380% since then. If any of you don't know that stock, have a look at it. They're at the epicenter of 3 mega trends. The Department of Government Efficiency, DOGE, they're going in and revolutionizing the US public sector. Their proximity to Trump is really close. They were the original backers of his 2016 campaign. Shouldn't matter, but it does. And they've also at the epicenter of the US defensive complex. The third name that I want to talk about is a quality name. You know, the great thing about quality names, particularly defense names, I think it's a fantastic thematic at the moment, is that they play a defensive role in your portfolio. So when, from a geopolitical perspective, things are getting tough, the world's getting less safe, these names actually tend to do incredibly well in your portfolio. Pair that up with tremendous tailwinds of growth, because for the first time in decades, every single country around the world is increasing their military spend out of necessity. So the European defensive names like BAE Systems, Rolls-Royce are doing it extraordinarily well. You know, Rolls-Royce, 25% of their portfolio is defense. So you put together the best of value, best of growth, best of quality anywhere in the world, and if we're getting it right, this is what it'll look like. So this chart here shows the monthly outperformance of the Plato Global Alpha strategy since inception over and above the MSCI World benchmark. And you can see that funds started off in a bear market. There was also a value market. We're consistently adding value, consistently outperforming the market. Then suddenly, ChatGPT, AI frenzy, we're off to the races with a huge growth bull market. We didn't reposition the fund whatsoever at this point. We just positioned it in advance to be robust to when that inevitable turning point that no one knows when it's going to happen when it does arrive. And we've continued to outperform extremely well since that point. So the nirvana we're looking to give you is that all-weather consistency over time. So I've spoken about value, growth, quality, you know, pretty tired old investment themes maybe. I hope I haven't put you to sleep. Sometimes I put myself to sleep talking about it. The red flags, though, is something that is totally unique to Plato. I've never seen any other manager anywhere in the world systematize red flags in this way. Like, we all use red flags in our day-to-day or even in our investments. But what we've done is we've got 150 red flags that we can bring up instantly before we make any investment, long or short, to identify if something is amiss. The origin of this very quickly was over a decade ago now. I was invested in a Spanish tech company. And this has been a great investment for us. We're thinking we were rock stars that had gone up sixfold. And we wake up one day, it's a huge accounting fraud. The revenue's a mirage. Stock price goes to zero. CEO gets indicted for fraud, goes to prison. And we're like, okay, let's make sure we never have to go through that again. And we did a really thorough post-mortem, and we noticed a couple of things that were really interesting. First, they were paying their auditor peanuts. Okay. The second one, their auditor was a total unknown. Okay, very simple, right? But that one pops up again and again like a bad penny. A name domestically that we've been short, off 50% since we shorted at Mineral Resources. Their auditor, up until relatively recently, was RSM Group. Nothing wrong with RSM Group. They do some very fine work, but they don't audit another company in the ASX 100. They don't audit another company in the ASX 200. Okay. Second red flag, that when we built up this arsenal of red flags, we looked at the likes of Enron, poster childs for special purpose vehicles, related party transactions that pop up again and again. We are a big believer in incentive structures. So when there's incentives of management are misaligned with incentives of shareholders, that's a big red flag, just like in the GFC at the big banks. So no clawback provisions, golden parachutes. We've got some fantastic data on the corporate history of executives. Have they been involved in misconduct at any point in the past? We look very closely at the buying and selling activity of insiders. Most of that buying and selling activity you should actually ignore though. The ones you really need to pay attention to are when the stock price has been punished, it's off 50, 60%, and the CEOs, CFOs are selling in size. Okay, a great example of that, Liontown. Around Christmas, they sold CEO sells $1 million worth of stock after the stock was already off 50%. Okay, that tells you that it ain't coming back. Sure enough, 6 weeks later, what happens? They're forced to disclose to the market that their entire financing syndicate had fallen through. We're already short that name. Stock falls another 25%. So the red flags, 8 or more seems to be the magic number. A big constellation of red flags, and that tells us that on average, that company will underperform the market by about 20% over the next 12 months. It's the most powerful signal we've ever identified for getting great shorts, but also capital preservation. Buffett, very fond of saying that there's only 2 things you need to know in investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And that's exactly the case with the red flags with names like Satire, which is a name that many of you will know well. Optically, it looked fantastic. They'd gone from 0 to 700 million revenue in a few short years, selling high-end luxury at 50% discounts. And we were long that name, but the red flags kept ratcheting up, and we said, no, it doesn't matter how good it looks superficially, we're out. We got a bit lucky with the timing and the stock fell 40, 50% from there. You put those elements together, the red flags, the best value growth quality anywhere in the world, 24% annualized return since inception, but I want to draw your attention to this number here, the downside capture. So 74%, so what's that telling you is that when markets are selling off, we're preserving capital better for you than the market. And that's, that high quality approach. The shorts are certainly helping there as well. And that's a number that's obviously really important to our end clients. But just finishing off, this chart here shows the performance of Plato Global Alpha since inception. Okay, and what you can see, that dark navy line right at the top, it's a really smooth trajectory. It's exactly the same as my experience at JP Morgan because the DNA of the strategy is the same. This is a highly repeatable process. And that's really what I think investors are looking for, that consistency over time. So putting it all together, we're Zenith, Lonsec recommended. The assets are growing really rapidly in the strategy on all the major platforms. We launched an active ETF in November last year. We're getting huge flows into that, which is very exciting. And overall, it's a really simple story. We've been doing this a long time, long track record of generating not only high alpha, but very consistent alpha. The red flags are an integral part of that. So if you're interested in having a chat, I'd love to meet with any of you individually and have a deeper dive. Thank you very much.